going live, preparing to live stream. There we go. I think we're live now. It is 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast. I think it's 6:30 UTC. I might have accidentally put in 5:30 UTC. Sorry, team. All the daylight saving changes is.
Who can keep track of this? It's too much.
I was an hour early.
I don't think you're the only one, honestly.
Oh, okay.
I got a few tweets.
I was talking to someone.
A few guys tweeted at me to say what's happening. Yes, sorry.
That's good.
What's happening, fellas? Bill's not here. It's Thomas Braziel.
Welcome.
My brother's name's Bill. I could just go by Bill today.
Close
Bill
enough.
And Tom. We got someone from the Caribbean, Vancouver, Saskatoon, Henderson.
Yeah.
Bill got that hair, did.
Do you have a what's the craziest locations you've seen people dial in from? Should I even ask this question?
Mars.
Yeah, I don't know.
Mars.
I mean,
that's pretty crazy.
you just self. Oh, there we go. Townsville. So there's the Aussies are in the house. It's an early start for the Aussies.
Exit 9 in New Jersey. I've seen that one.
Medellin.
The metaverse.
I think I want props for getting Saskatoon and Medellin correctly pronounced.
Wow. International.
Yeah.
What topics we got today? Toby, do you have anything prepared?
Yeah, I did. Jake and I have just come off another podcast, but I found this interesting little chart showing returns and valuations by style, little style boxes. It's got 10-year annualized, 20-year annualized. I tweeted it out last week saying there's plenty of confirmation bias in this for anybody looking to support their own story. So I'll be using it to support my story coming right up.
A Rorschach test of charts.
I'll give Tom a little bit more time to think about his topic. And JT, what's yours?
Yeah, I've got friend of the program, Rishi, sent me an article from that's on complexity that I thought was interesting, and there's a couple other things to just tie it into that I've come across in the last few days. So I was inspired to weave some strands together, and we'll see how it lands.
Tom, big ask, mate. Have you got anything?
Me? Oh, geez.
Bankruptcy, crypto.
I got absolutely nothing. I could talk about the intersection of like crypto and the legal system because it comes up a bunch for myself when it comes to like doing distress and anything crypto. And like for instance, like if you have DAO, like how is a DAO's not even a legal entity? Well, how are these things going to work through the legal system?
What's
DAO? Like a
distributed autonomous organization.
Distributed
or something
autonomous
like
organization.
So it has no legal structure. What is it?
Good question.
Computer code.
I don't think the legal system is quite wrapped their head around what it is. And also,
well, it will have a default. Like it'll default down to something. It'll default down to some form of partnership or something like that.
Yeah, but there's not even like an LLC set up in places.
But you don't need an LLC. You can have a partnership which is just without any sort of documentation. Any real lawyers in here, jump in the comments and let me know. I think that's the way it works.
The chat box. Well, I would say like one thing is like how DAOs are interpreted, how tokens are interpreted, whether in legal disputes or in like, courts of law, whether it's a bankruptcy court. Like we had this come up where tokens were considered, maybe they were going to be vouchers, they were going to be coupons, they were going to be equity. So it's very interesting from like a distress standpoint, like how these are treated, and then legal interpretations of crypto. So I could talk about that. That's one thing I talk about. Or another distress topics.
I'd like to hear that. That sounds interesting.
Okay, yeah, I can unpack that.
Where's Bill today? Do we resolve that? So people want to know.
I heard. What did he say? Where does anyone know where he is?
Y'all don't know? On an airplane, I think.
Somewhere cold. That was what I gathered from
the tweet. He said something about crisp air. Yeah,
crisp air. Yeah, that's Colorado. All I got too. Rocky Mountain air, maybe. I don't know. Yeah, evidently I pronounced the wrong one. Saskatchewan, not Saskatoon. Sorry, I thought that was how you said it. Anyway.
Sorry, Canada.
Sorry, Canada.
Luckily, they're very friendly, so it's okay.
You're already forgiven.
You're already forgiven. presumptive forgiveness.
All right, where do we want to start? You want to tell me what you go first? Let's get some confirmation bias out of the way.
Yeah,
Feel good about ourselves.
Yeah, then we'll work down from there.
This is a JP Morgan asset management slide. Got the 10-year annualized returns for value growth, small to large, and there's mid in there as well. So
whose definition of value?
Yeah, that's a good question. FactSet, Russell, Standard and Poor's. I don't know. I'd have to read. There's a pretty big disclaimer at the bottom. I don't think everybody's got the time for me to go through it.
No one's got time for that. Yeah. Okay. Sorry.
So last 10 years annualized, large growth, no surprises, big outperformer, 19.2% compound for the decade per year. Wow, that is good returns.
Great. Put my money in that.
Small value, 11.8%. That's actually still pretty good.
That's
historically.
Respectable.
That's a very good return. Large value, 12.5, slightly better. Small growth, 14.3. So the answer was the more growth you had, the better you did, and the bigger you were, the better you did. So
not normal historically, right?
Not normal. Yeah, not the usual experience, not the typical experience. I found this interesting though. This is the current price earnings ratio as a proportion of its 20-year average. So I'm not going to give you the ratios. I'm just giving you where it stands relative to its 20-year average. So growth is 165, large growth 165.6%. And this is the highest. So
that would be like saying normally it's a 15 PE, but it's 165% of that, whatever, 15 or something, some number like that.
Right. So that's like in the low 20s or something like that. Mid growth is 179%, small growth 141%. Even large value is 118% of its 20-year average. So it's expensive. The only one that's like under its 20-year average is small value, but it's at 98.4%. There is nowhere to hide.
Average price, basically.
It's average price. Yeah. So it's probably going to deliver its average returns, but you get what you get in the interim. I don't know what to make of that. I think that the returns have followed the valuation. So the more overvalued you've got, the better your returns have been. But none of those things are cheap. Like it's not clear that small values basically at its long run average, which is what I've seen in other studies as well. So I'd say you're going to get some pretty. There's nowhere to hide. This is all US though, so maybe if you look globally, maybe you got to like crypto or Tesla. That's the solution. I don't know.
That's where you hide.
Yeah, that's probably where you hide. I don't know. Yeah. What are your thoughts on this, Toby? What are we supposed to be doing? Maybe you're not. Well,
first question: is reversion to the mean dead? You have to get comfortable with that.
Yeah, I'm not going to bet on that one. I'm not going to bet against reversion to the mean.
There's two issues, right? There's the growth argument is that the companies that are in that growthy bucket are destroying the industries that they're in and accumulating all of the profit from those industries. And so there's no scenario where Google's business mean reverts or Microsoft's business mean reverts. Then you're looking at the index and saying, well, the index is like, we blew through 40 on the Schiller PE, not that matters, and we're like still pretty greedy on the fear and greedometer. So is there going to be mean reversion in those valuations? There may be mean reversion in the valuations, but not in the underlying businesses. And then you get guys like me who are hunting around at the uglier end of it, hoping for some mean reversion in the business and in the pricing. I don't know. I feel like it always has, and I feel like there's some evidence that it is mean reverting. So I still believe in it. But the market can be, irrational for longer than you can remain solvent. Where I think we've blown through anybody's estimate of how long we could remain irrational. Let's talk Rivian.
Yeah, let's just punt on that idea.
It's got no revenue and $135 billion market cap today. Woo, that's expensive. 135 billion. You used to have to actually do something. You had to be reasonably well performed to get to that kind of level.
Yeah, but not to cast any dispersions on crypto, but I mean, that's what's that, at $1 trillion market cap and no revenue?
It's a currency though.
Yeah.
Like, would you say what's the US dollar at in terms of market cap?
All of it? I don't know how that.
I think have you ever read, there's a Chris Burnside book? I think that's his name. He used to work at ARK. He was like their head of crypto. Can you guys hear me okay? Is my connection okay?
Yep. Oh, you're good.
Yeah. And he had some like idea of valuing it like you do, like where you look at like the velocity of money, basically to value the underlying crypto. But you don't need to do that with a lot of like protocols that use smart contracts. But I don't know. I mean, Bitcoin's kind of its own thing. It's sort of like in compared to the other cohort of cryptos. But yeah, I mean, the valuation
Ethereum's
is insane,
up there with Bitcoin, isn't it? And Cardano,
yeah, but
aren't they all sort of?
You could look at their usage and adoption, and you could come up with some sort of like S-curve valuation, or I guess stock and flow. But then you can also look at just like what kind of fees are generating in terms of gas fees. So like, you know, a lot of those, and think about, okay, the valuations are high, but the growth rate has been spectacular. That doesn't mean it'll keep going. But
Do you value it on that basis? Like, how do you think about it?
For myself,
yeah.
I try not to overthink it. Frankly, I study it a bunch. I just rarely get answers. I mean, on one level,
approach, I think, actually. Learn a lot, but don't necessarily assume you have all the answers.
I meet a lot of very smart people in space, and some are not, but once you get away from just like people punting around on coins and things, I meet some very, very smart people in the space, and they can have some pretty crazy models about how to value this stuff. But it's not fool's gold. It's just like they're very aggressive assumptions. They're talking about winning huge categories. I mean, and if they work, of course, they're worth, just like Rivian, they're going to be worth a huge amount of money. But you've pulled a lot of that forward with the current valuations. I don't think anyone would say against that. Even the venture capitalists are putting money in the space, and sort of, I guess, I don't want to call it smart money, but like more thoughtful money with institutions and things that are invested in with some of these managers. They're not going to lie and say that a lot of the valuations haven't been pulled forward. In fact, they don't mind, because most of them have access to valuations that you and I could never get. They do pre-IPO type deals, but not pre-IPO, the pre-ICO deals where they're getting tokens, that are getting rev shares on token, like, rewards between now and infinity, and they're getting them now, and you don't get access to it. I don't get access to it. So I look at a lot of this stuff. I find it fascinating. But even like helium, we were talking about just before we got on, you look at the deal that the VCs got, and that they made out great. You and I just punting around the coin, that's a totally different transaction. It's like people talking about buying B of A versus Buffett's B of A. It's a very, very different transaction. And so I think some of the people don't appreciate that sometimes in crypto. So the valuations are insane. But what's better than expectation in a story without actually having to deliver? Like, that's crypto, like, fits all the check the boxes, like all these great growth stories, but it's all out here, so it's a perfect storm for overvaluation. But I'm still a believer, if that was the question, in the technology.
What is it that appeals to you about it? Is it that replacement of gold as like a hedge against fiat currency? Is that the attraction to it, or is it what else is it?
Sure. Yeah. I like the autonomy, like, individual sovereignty, people that are real cypherpunks. If you go and try to get past all the speculative crap that's going on, and who knows what some of the tokens are worth, and who knows what Bitcoin's really worth. Some of the ideals and ideas of, cypherpunk movement, and then now sort of, I guess, crypto and general movement, are pretty revolutionary. If you think about it, like self-sovereignty, like censorless internets, like Web 3.0 projects that are incredibly interesting. I don't know if you guys have ever Jake or Tobias, Toby, have you ever looked at any of these? You all ever looked at any of these like Web 3.0 projects?
No. What do they do? What does it look like?
So like there's one called Rware, another one, and they're basically the whole internet is going to be archived using like a cryptographic sort of system with like rewards. So the idea is like no one can take down any pages. Like there's no censorship of the internet. They can't be blocked by governments, things like that. The same thing kind of, I guess, Helium, the idea is to have like a sort of a censorless infrastructure of like Wi-Fi hubs or whatever. Another one that I really like is supposed to be like a sort of a cryptographic like GitHub. So like GitHub, when all the repository of computer code is stored in GitHub, which is owned by Microsoft, which is kind of bizarre. And this is going to set up basically an independent structure where they can have like GitHub where people are putting up all the code that basically runs the entire planet of software that we all use, and things that we don't, any electronics, and they're going to have mechanisms for paying people micropayments that maintain the code or fix bugs in the code and things like that. So and it's not going to be owned by anybody. It's going to be basically this sort of out there thing where it's totally censorless. And I think that's incredibly interesting and powerful. Who knows what the token's worth? Honestly, who gives a shit what the token's worth? It's not the point. The point is like something that is very interesting and powerful and probably great for humanity. So that's why I'm like fascinated by crypto, but that doesn't mean I'm like going out and have like a bunch of coins in my wallet and oh my God, it's up 1,000%. Like, who cares about? I mean, like, I understand people, people invest money to try to make money, but there's so much more to crypto than just punting around on tokens, which is what's talked about, all day, every day.
Yeah, I find that aspect of it, the token punting, like boring as hell, but the other part is very, very interesting. The DAO, the distributed organization. If you can find some way to make that, eternal, make it keep on incentivize people to use it and keep them functioning, because that's the problem with all of these things kind of break down over time as the interest disappears. But if you can find some way to keep on incentivizing people to work on them, then that's very interesting. Probably
it's
even
provocative. The thing could hold.
They don't have a legal.
It's an experiment. It would just it could just disappear.
You never want the legal entity sorted out right. You want them to remain in that.
Oh yeah.
Because if you sort out the legal entity, then you've got residence. You got residence issues. You'll have taxation. You got other things. But if you don't ever resolve that issue, then it's just not resolved, right?
Is it possible, Toby, that you could have? I mean, someone could still sue you in a local court of jurisdiction, even though you're a foreign corporation or a foreign DAO. You don't need to say, you know what I mean? Like if I sue someone in New York or Delaware or California, like just because that's my location and we had some clear contract. I mean, if that organization claims to be a DAO and it doesn't really matter. I can sue Jane Doe, John Doe.
You can sue anybody, and but you got to be able to collect on the damages award.
Well, yeah.
So that changes the equation.
Details.
You can sue anybody and win. Some people are just not worth suing.
I mean, I don't mean to jump back to what you were saying, but I mean, you were talking about high growth companies, large cap growth companies. Not all those high growth companies with those crazy valuations are Microsoft and Google. I mean, no offense.
I don't think that those are the ones who have crazy valuations. I think those valuations are sort of stretched and expensive, but I don't think they're insane. I think they're
promptu. Working from home. I
think there's been some. There's been quite a few reckonings for some of these more over. Like Oatly was down 20%, 50% yesterday.
Love the product too.
All of those things have been kind of blown up a little bit. Rivian, just a matter of time on that one. Time and patience will wear that one down.
What do you guys think what do you think I think one of the most interesting opportunities, not Oatly wasn't a SPAC, but it kind of makes me think of all these crazy SPACs. Like all these busted SPACs are going to be such great, like hunting opportunities, I think.
Long or short?
Well, busted SPACs.
I don't know. Okay. I don't know. Yeah, busted. I wouldn't say, no. It's like, no, I wouldn't. Although I've been sucked into some of the stories when they're down a little bit. And then of course, I'm like, woof, I didn't swing at that one.
2008 and 9 were
Ouch.
fun when things were trading below their cash backing and you could get like 15 or 20% just by holding them and voting down the whatever deal they tried to Hail Mary at the very end. I think that'll be happening again.
You were totally that guy, Toby.
That was pretty fun. I wasn't the only one.
And no.
There were lots of people who voted no. In fact, the majority of us voted no.
No, I know. I'm joking.
JT, you want to give us some vegetables?
Sure. So this there's this I guess you call it a blog post at this point. It's called "What I Learned from Complexity," and it was by Cedric Chin, who I'm a fan of, mostly because he said nice things about my book, which always makes me feel good. So that's so hi, Cedric.
He's got taste.
He's actually a good Twitter follow too. So if you find him, but so he's talking about Mitchell Waldrop's book called Complexity, that's about the Santa Fe Institute. It kind of gives a story, the narrative behind that. And, I think we know a fair amount about these things already, but let's work through some of it. It's a large network of components that they have no central control to them. And they exhibit complex behavior that emerges from, sophisticated info processing and adaptive learning that is more than the sum of the parts, right? There's the interplay between the nodes is what creates this kind of emergent phenomena. And he uses actually traffic as an example of a complex adaptive system. And I really like it. I think it might become I've tended to use more biological references like ant colonies and things like that for the analogies for complex adaptive systems, but actually traffic might be better because more people have that as a mental model that we've all been stuck in a random ass traffic where what is going on here? There's nothing, right? And then it lets up and there was never anything there to justify why you were stuck in traffic. And so this pattern that it's impossible to predict. You have sort of the starting, we know what it looks like right now, right? We could go onto Waze or Google Maps or any of these other traffic, apps, and we can see what it is right now. But making predictions about it in the future is so that the actual end state of the system at any point in time is incredibly difficult to predict because there are little feedback loops that get turned on by some little random, the proverbial butterfly flapping its wings. And it leads to these, cascading changes within the system that are just impossible to predict. But we know we can observe characteristics about it as it's happening. And we can see that, we can see tendencies. So, the 405 on Friday night, Toby, what's that going to look like? Probably
doesn't have to be Friday night.
the 405 at 3 a.m. on a Sunday night.
Christmas morning.
Christmas morning. What's it look like? We can make generalizations about it and have some idea, but it's incredibly difficult to predict it. So let's start with that as sort of load that as a mental model into our minds. And then I'm watching the 60 Minutes segment from Sunday night where Ryan Peterson of Flexport, I don't know if you guys know who he is, but he's a pretty interesting guy. What's that?
I saw that. I saw that interview.
So, he's flying over the LA port with Bill Whitaker, and they're talking through what the hell? Why are all these boxes stacked up? What's the problem here? The whole thing's snarled up, right? And it's a traffic jam effectively. And it's getting worse, right? The ports are packed, and a lot of it is because the shopping from home binge that took place while we were all stuck at home with COVID, it started to get worse from the beginning, and it's been growing and getting it's cascaded into this. And it's taken much longer, I think, to play out than what maybe all of us wouldn't imagine. But that's how complex systems work. They're really hard to predict, how they're going to cascade. So, some people are blaming the shipping companies for jacking up rates a bunch because I think it's 10x what it was a couple of years ago to ship a box from Asia to here. Some people are blaming the ports for not processing the containers fast enough. Some people are blaming the truckers for not being available to get the boxes out of the port, so they're all stuck there. Some people are blaming the port that the truckers, there are all these apparently empty chassis with just empty containers sitting on them all over LA that they can't get them back into the port to send them back. Like the whole thing is just foobarred at this point. And you know, it's so like we have now our governments are like, oh, this is a problem. Like we need a task force to come in here and figure this out. But like complex adaptive systems don't work from a task force, right? Like it's this emergent property to it. It has to almost clear itself out. Just like we couldn't say, well, we put in a speed limit or even a speed minimum. Why is there traffic? Everyone should be going 45 miles an hour on this road because that's what we said it needs to be. That's just not how it works. And my hunch is that this might actually take a long time to get figured out, and that it may take, I don't know, like we may have snarled port for like a couple of years from here. And that wouldn't be actually totally surprising to me.
That's the estimate that I have seen at back end of 2023. And when I hear back end of 2023, that's just like, I don't know. We don't know how to fix the problem. It's going to take so long. We don't know how to do it.
Yeah. So like, what are the knock-on effects of that then? As far as, you know, Christmas of 2021 obviously has a question mark on it. Christmas of 2022. I don't know. Like what does this change in our world? I think there's actually probably some big stuff that could be a consequence of this. And it's even like that these disruptions, like any system, have echoed out kind of fractally into the system. So like apparently the Chicago rail system, that hub is just totally snarled as well right now. And they can't get boxes to the right places and moved around. And like it's echoed out through the supply chain. So then we have that sort of as like an observation. And then I read Roger Lowenstein had a I guess you can call it a blog again, of what if the Fed is wrong is the name of the article. And you know, he's talking about the annual increases in the cost of everything, which are probably largely related to this supply snafu that we're running into. But like beef is up 20% year over year, furniture 12%, eggs 12%, cars 10%, clothes 10%, gasoline 50%. And you know, we're talking about like, oh, wages are going up, right? Like we have this great you know, everyone's quitting the great resignation, but actually in real terms from January to today, real wages are down 2.5%. So I don't know if wages are necessarily keeping up with this. So meanwhile, you know, we have another complex adaptive system, which is our whole economy. And then we have, you know, kind of this fiat level above that wants to dictate, here's what needs to happen. We're setting rates for this. We need to have all this stuff happen. Dude, that's not how complex systems work. And so this idea that the Fed is going to engineer a soft landing of all this and be able to raise rates in 2022 or 2023 and, you know, thread the needle perfectly between supply constraints and the right amount of money supply to be having circulating around, like this just seems like such hubris to me, to think that you take a mindset of that this is a washing machine, like with knobs that you can dial in and pulleys that you can mess with. It's nothing like that. That is just totally the wrong model to be approaching this world. And I can't help that we're all not going to pay a lot of kind of real physical prices. I mean, actual, you know, inflation, but also just like the toll of quality of life from people having this assumption that they know the right knobs to turn on a complex system that is incredibly difficult to predict. I mean, these guys, how do they know it's going to be transitory? They didn't know that COVID was coming. They didn't know that the supply chain was going to have problems. They didn't really know 6% inflation was going to print. They didn't anticipate this great resignation. They had none of this stuff baked into it. So why do we think that they're going to know the answers prospectively from here? I don't know. It just has me scratching my head as to why we put much faith and this much power into these kind of organizations.
I thought that the articles that I have been seeing are not that it's transitory now, that it is here, but it's good for you. Inflation is good for you. There's plenty of articles out there like that now.
It's like fiber. It's just so good for you. Can't get enough.
So wait, my real real wage of minus 2.2% is good for me. That's what you're telling me.
It's good for inflation. Is good for you. Like I'll find some articles and repost them. There's plenty. I saw that the air quality in Los Angeles is down because of all the ships idling out in the bay.
Yeah. So there's 80 ships apparently off, which is a record, and it just keeps building. Like it's as worse today as it's ever been. So this isn't like it's not clearing up. It's going in the wrong direction still.
You can walk to Catalina Island over the shipping containers. You don't have to take a boat anymore.
My kids love it. The giant.
I don't know. What do you guys make of this? Am I just like tilting at windmills here and totally off my rocker, or are we creating the problems that are going to have real impact?
I think you're exactly right. I think that I'm of your school of thought as well, and
this is the problem.
You and I, unfortunately, you and I. This is complete conspiracy theory podcast type stuff where you and I get on and agree with each other.
Yeah.
Everybody else just tries to be quiet. Let us
get demonetized together.
Yeah.
Hey, what are you guys agreeing on? You agreeing that inflation is not transitory, or that this is a grand experiment in monetary policy?
Yeah, all of that. Yeah.
Okay. How can anyone not think that at least a decent probability of being the case?
Do you read them? You go and read like any mainstream article out there. Nobody in the world thinks this. No, well, nobody with a mouthpiece thinks this. Yeah.
Well, and what is a $1 trillion or whatever infrastructure, like throwing money at it, do to solve this problem either? Like we have a real physical atoms problem in the world that needs to be figured out. Like it's a supply chain problem. It's not we don't have enough pieces of paper chasing the supply chain problem.
What we need to do is mint the coin. We need to mint $1 trillion coin, and that will solve the problem.
What does that do? I don't understand.
It solves the problem.
Okay. Well, fair enough.
You're not serious unless you're considering mint the coin, I'm told.
I think, maybe it's more of an agency issue, which is like a lot of the people, it's like hard to come out against these things because like, you talk a lot about momentum. I mean, like there's so much momentum behind not this, right? Like, so, what's working is working and what's not is not. And, if you want to lose your job, you can sort of like really stick your neck out there. Now, if you're a smaller person, like in the ecosystem, and you can probably be vocal and it doesn't cost you as much. But to be big and outspoken against, I'm sure, you
don't get invited to Davos with these kind of views.
No, we're out for Davos for sure.
Yeah, there goes our Davos tickets. Yeah. I don't know how someone can't think that like MMT is not like this, grand experiment. I mean, for myself, I definitely think it is. That's maybe partially why I'm into crypto, but also like I got it in a very backdoor sort of free optionality way. But I'm actually gotten quite interested in gold as well. I mean, when you listen to crypto people, especially Bitcoiners, Maximals, they sound a lot like gold bugs. And what I love is like they don't think that either. The two parties are like one's over here and one's over here, and they're like, you listen to one, they're like, That's the other one, they're like, and you're like, you guys could actually be friends. You guys would
be really good friends if you just, yeah.
Like Peter Schiff, like I think that you guys could actually. There's a dance here. Anyway, but it's funny to listen to people that are crypto and they don't think any. And the same thing with. Yeah, I love to hear someone who's like 17 or 20 years old and they're into crypto. And you just think like you basically sound like a 75-year-old gold bug.
Yeah.
I mean, it's not wrong. It's just it is funny. It's funny how like it's such a conspiracy theory. It's so far outside the mainstream that you read every day, and I don't talk to many people who disagree. That's the funny thing. There'll be someone drop in the comments here. Tell us what we're wrong.
This wasn't live, right? We were just talking.
This isn't going out to anybody. Right, we're just talking among ourselves.
The feed was cut.
If you print a whole lot of money and you reduce the number of goods that are in circulation or able to be consumed in a sort of timely fashion, that's almost definitionally inflation, right? And then that's why the argument is that it's transitory. But the money printing's not transitory. That's going on, and the snarl's going to be real for a very long period of time. Maybe when the snarl's resolved in the back of 2023, if we print enough money between now and then, we'll be okay.
Here's the problem, though. At least for me, is that the velocity of money has been incredibly low. And that is largely a psychological phenomena. And so if you monkey around in here too much and you tip the scales of the psychology part of it, it's totally possible to me that you move from, velocity. If velocity picks up at all, you have the dry powder of all the little token or all the claim checks that would be chasing these goods and services. That tips over, and now the genie is out of the bottle, and now you run straight to 10, 15, I don't know, whatever percent inflation. And good luck. Then it's going to be real painful getting that back, like that genie back in the bottle, and like a Volcker type of backbone and fortitude is needed. And like, boy, I don't see many public intellectuals or much discourse where there's a Volcker type of mentality of paying today for a better future.
Chatwood had the inflation running at between 11 15%. I think it was 11% pretty consistently for Los Angeles anyway when I had a look at it. That's why Chatwood got nuked.
Wouldn't you, but I mean, I have to say, like, don't you think the solution is that if this is an investment program, I guess, I don't know if it is, but I know it's not, that's an entertainment, this is entertainment. But when you say the prescription, like, okay, some people try to do crypto, some people try to do gold or whatever, but like the prescription could just be finding great businesses. I think Buffett's totally right about this. Not that I need to tell Buffett he's right about anything, but that, finding great businesses that can compound or have incremental, high returns on an incremental invested capital is clearly always going to be the best hedge if you don't pay a ridiculous price for it.
That's the solution for guys like us who've got enough money to cover what we eat every given week.
Yeah, that's true.
And
right. It's tough on wage earners.
We're fine on that front. Yeah, it's tough if you're closer to the poverty line. Like the closer, all of the money printing. This is why someone made the comment before that AOC and Peter Schiff are pretty close together. They're just disagreeing on the policy prescription. They both identified the problem. It's surprising to me that some of the left don't figure out that the money printing is a big part of the problem. It benefits those in the top 1% at the expense of those closest to the poverty line.
That is kind of a grotesque outcome, isn't it?
Say it again.
That is a grotesque outcome in a lot of ways, right? And very counter to what you would sort of think that a progressive agenda might prescribe.
Look at the cost of a turkey. They do this, the cost of the turkey dinner year on year. So it's gone up like modestly every year. And there are other competing factors in, like we become more efficient at growing turkeys and getting stuff to places, all that sort of stuff. Like honestly, there is a natural deflation there because where technology advances and creates deflation. So you've got to work really hard to get those prices up. So year on year, turkey price has gone from $20 for a turkey dinner last year to $55 this year.
That's what it's.
Wow.
That's going to sting.
Where's the Big Mac index? That's my favorite one.
That's the Bergonomics. That's the economists' purchasing power parity.
Right. That one's good for international trade.
I was just thinking of Big Macs, but yeah. My brain wandered.
So is everyone substituting do they factor that in when people are substituting for shit? I know I went to Costco last week and I came home with hamburger and not steak.
It amazes me that they're allowed to count that as like against inflation. That's a thing you do one time. It's what a bullshit kind of assessment of the CPI to do. It's outrageous that they can get away with that. Also, the hedonic adjustments, like, give me a break. You don't get the advantage of technological advances to say that that's deflation and therefore we need a policy prescription because the TV or the computer is faster. So now, we got to print some more money to make up for that. How? Like, why does that work?
Toby, you're not going to get a PhD in economics now.
I'm not. Honorary. This is probably going to be demonetized. I'll probably be tarred and feathered.
I don't know about that. There's got to be some. Who are the schools of economics who think this is kind of like an MT is kind of crazy?
Austrian.
I don't even know. I guess Austrian. Yeah.
But Austrians like just as soon as you say Austrian, you can be dismissed because it's
crackpot.
It's only crackpots who believe in Austrian.
When I think I went to their website or I was on their maybe I was on their email list or blog list or something. And I would get some things and I'd be like, this stuff's pretty crazy. I don't even want, I'm interested in like that bit of it, Austrian. I don't know about all this other stuff they're talking about.
Which part did you object to?
I can't remember. It was stuff that I was not interested in. I'm very one dimensional. I find myself like really only interested in investing things about investing. So I think it got very political, and I was like, oh God, politics.
It is political. It's political.
I'm going right.
That's the problem, right? It's political, but it's all political. It's just that there's one
Right.
One form that is politically acceptable and the other one is not. Investing with Tom says 510 is the new 6-foot inflation. I think that's my solution for daylight savings time too. So I think in the summertime, we should make the foot 10 inches. So therefore, when you go to the beach, you'll be 6 feet tall. Everybody, like all of my short kings out there who are like 5'6" and below, I get you to 6 feet for the summer. Who's with me?
What else are you measuring?
Inflation still? I think we're still talking about inflation.
That's my daylight savings prescription.
I mean, I find, in fairness, I've done quite a bit of study of Austrian economics over the years.
Oh,
and
really? Cool.
I find it to be similar to value investing, actually. Like, I feel like they're sort of cousins in a way of, like, this is what a business person would look at and say, like, okay, here's the interactions of people and here's what the business is doing. And therefore we can say some things about what does this system exhibit. And I personally find it to be compelling. And I've had some kind of grandiose ideas of actually trying to like marry the two together into a cohesive framework and like maybe like talk about it at some point, but it's like, it's
there's an article there's an article by Chris Leitner called it's like value and value in Austrian economics. I posted on Greenback a long time ago.
When Mises met Graham or something.
Is that
like
it? Yeah. That's a good article.
Wait a second. I want to look that up. Is this, so you mean like what, the idea of like the boom and bust cycle, and maybe even like weaving that into like the marathon idea of like, what is it called? Capital cycle theory?
Marathon are very Austrian, right?
Yeah.
Yeah.
Yeah. And also, entrepreneurial errors and how do they manifest within the system, and what causes the entrepreneur to make an error as to like, what do people actually want from that business? I find it to be like a pretty useful framework myself. Maybe I can't always express it, but it's somewhere in here.
Speaking of on that topic of like macro and then putting it into like an investment sort of policy or strategy, have you guys ever read the book Keynes on the Market?
I've read a few Keynes books. Possibly I've read
on
that
the
one.
Market. Dude, it's phenomenal. It's basically, I guess, what do you call it, where it's like letters that he wrote back and forth to someone about his changing, what do you call that, compendium? I don't know what you call that, but basically they take all the letters that he wrote to a bunch of his friends over the years, and it shows his like investment philosophy, how it changed over the years from being like, I mean, there were a few papers that came up and got pressed, and like Jeremy Jason Zweig at the Wall Street Journal. Like they got picked up. Yeah, I picked up in the Wall Street Journal. But he, like, early in his career, of course, was like very macro, and then towards the end, he was basically an iconoclastic like value. You know,
he was very
Buffett-like, contrarian.
And Buffett gives him a shout out in one of his letters as being one of the models that he used to formulate his own investment strategy.
Specifically from the his main like treatise on
the general theory.
Oh yeah, totally. Yeah, general theory chapter 12 is great. Oh my God, manna from heaven.
It's funny that Keynes had that. He thought that his superior understanding of the cycle would be the thing that would help him. So he was global macro and blew up twice and got bailed out by his dad. And then then he sort of learned his lesson, and he makes this statement, and that's the statement that Buffett quotes, where he says, "I'm increasing. The more I do this, the more I think you just sort of try and find businesses that are going to do better over time, and you just try and participate alongside them." But his investment strategies were interesting. Like he did deep dives into, you know, how much money you could make per car in some of the automakers and things like that. He was a good investor. He was very early in Tesla.
Very early.
Oh, actually, the Tesla, the man.
I wrote a little
Yeah.
bit of it. I wrote about it in Concentrated Investing because I covered his investment strategy in that, because he ran a couple of King's College and he ran 2 insurance companies. And he has some great quotes too, when like at the bottom of 1929, when everybody was devastated and the performance in one of the insurance companies wasn't great, they fired him. And in the other insurance company, he said, we can liquidate now and put ourselves into bonds, but like basically nothing matters at this point. Like if we do that, we've locked in the losses. Whereas if we stay long in this stuff and then recover,
At least
we
we have a
probably
chance.
recover. Yeah, and he was right. And his performance was excellent over a very long term. He had very, very good performance. But as a value investor, not as this sort of global macro genius that he's regarded as today among some quarters.
Well, in fairness,
I should have said I referenced the wrong book.
I feel like the salad bar, picking what you like from what Keynes said and not the whole prescription has been a lot of the problem. So like, I think when people blame Keynesian economics, I think no one ever does the part where you save money for the rainy day when times are good. It's always just pump, 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 right? So maybe like we're not, to call this Keynesian, to call MMT Keynesian is maybe not fair to Keynes's original intentions.
Yeah, I still think it would be difficult to implement, even if you were trying to do it, because
the complex adaptive system conversation we already had.
Timing's hard. Timing in anything's hard. There are investors who study this stuff who understand that you can't get the timing right. Have a look at any of Cliff Asness's AQR articles where he talks about how hard it is to time factors. And he's been calling for value he was calling for a value recovery. To be fair, he was probably only out by about 12 months, which in the grand scheme of things is nothing.
That's pretty good. That's nailing it in the grand scheme of things.
There's a couple of good questions in here about grocery stores. What does inflation do to Whole Foods and Sprouts? What does inflation do to grocery stores? I can't remember, but I do remember that in the last time there was the 80s, this was a whole lot of inflation from the 70s. The 80s, a lot of the raiders went after supermarkets, and I don't know why they did that.
Well, generally speaking, unit economics of a grocery store are incredibly thin margins, high turnover, high velocity of inventory. So theoretically,
it shouldn't impact you much, right? As long as you're not holding onto it for long.
Yeah, you're probably passing through.
You're still getting squeezed, constantly squeezed, but you
always
shifting
were,
it.
right? Like you were always squeezed on a pretty thin margin. So
yeah, I think I knew someone that worked for a private equity firm that bought like one of the big private equity firms, and he was telling me, the whole thing is like almost a float business. Grocery store is like a float business. I was like, what do you mean? He's like, I was like, float like insurance float? And he was like, yeah. I was like, really? So like so much of their actual margin comes from that velocity. And then I guess just like the money they make it sitting in the bank while the velocity is going like this. So I don't know that prices make it huge.
I did hear a story like that. I thought it was Aldi, but it might have been some. I'm thinking that it's Aldi now, but the story was that basically they made no money from the entire supermarket operation. They only make the money from the float.
Yeah, that's what this kid was saying.
I mean, Costco's in the same boat, right? Costco doesn't make any money from its business; it makes it all from the subscription fees.
Yeah, I mean it's a little bit plus margin, but it's mostly membership fees.
Or the profit equals the membership fees. Is that an urban myth?
No,
I don't know.
That's real.
Let's phone Nick Sleep. Ask him what he thinks. I don't know.
Let's ask Charlie.
Yeah, did you guys see Monish dumped Barber?
I think trimmed is the
trimmed is not dumped. Okay.
I don't know.
Fading. He's fading it.
Who knows?
I don't know. How do you get into these big businesses? How do you analyze? Like, I mean, maybe he's got like real people working on it, but I don't know.
Analyzing the big businesses. In some ways, big businesses are a little bit easier, aren't they? Because they're a little bit more stable. It's the little ones that are whipping around all the time. Like little ones through this balance. Little ones through this this whole like shutdown have been really beaten up because where they've got one product and they're sourcing from only one supplier often. If their supplier can't get it to them, they're in trouble.
They do also tend to be easier though, like operationally to untangle
to understand.
big business.
Yeah. They get more probable. I think the bigger ones are more like sort of statistical, probabilistic.
I don't know, man. Lots of ways to make money.
Yeah.
Lots of ways to make money in the market. I don't want to knock anybody. I mean, I'm sort of a special sit guy, and I'm like reformed. I'm trying to like reform myself because I think that the after-tax return.
Reform to go further into special sits or to come out of special sits?
I think to set a higher bar for special sits because the after-tax returns aren't as good if you can compound at a decent rate in a real business. I use real business pejoratively to make sure that a real business, not some bullshit business. Yeah, so it's something, actually, it's funny, you were talking about topics. I'm changing my topic. That's all I've been thinking about recently is what's better, 1 year 40 or a 5 year at 15, and I pay the tax after the 5 years. And it's actually, I can even own in year 6, 7, and 8, and I can just peel some off, right?
It's so true. Like when you do that, when you do the tax arb is just that, like to get over 15% in a year. I'm going to slightly forget this, but I think it was long term. Even transitioning to long term from short term 40%, it's like a long term 15, something like that. And short term 40,
my point is even,
sounds high.
Yeah, go ahead. You have to crush it.
Maybe it's no tax. Maybe it's no tax 15 equals like I can't remember exactly. Wes Gray did the calculation a few years ago, and the numbers the numbers are, they're shocking. Like the numbers are the number that, and I was like, how many times do I see an easy 40% in 1 year? So you see some option stuff like that. Like you can get some options that IRR out at 40% over the course of a year. And if you're going to do that repeatedly through the year, you're working hard to get your 40 when like you can get your 15. There's a lot more 15 around.
I guess I'll just play devil's advocate here, Thomas, and say that
Please.
This is sort of the realization that everyone has been coming to the last couple of years, and that a lot of it I can't help but wonder.
I'm not a unique snowflake.
Well,
you're hurting my feelings right now. This is really hurting.
It's possible that it is priced into that in such a way where it's not that 15, and it's more like, do you want that easy 5 now, or maybe less? I don't know. So if it was 15, I'd say, shit, yeah, that makes sense. Let's just do that. Like that's easy. Let's just earn 15% ROE from here on these businesses. But I think a lot of that might have been pulled forward at this point as everyone's come to that realization. And, again, Buffett is 30 years ahead of all of us in the understanding and application, right?
Yeah. Buffett's been selling some stuff. Buffett's been raising cash. Not that he's a timer, just it is what it is. Sorry, keep going.
My thing is also not irrelevant to know what Buffett's doing, but it's like, you have to optimize for yourself, your own situation. For myself, I'm getting to the point where like taxes really matter, and I actually really like think long and hard about this, and also for just like quality of life, like sudden death securities analysis is a lot of work, versus finding good businesses where you could feel like you could be part of a company that's going to grow for 10 or 15 years or something. And recently, I bought a stock maybe a year ago, and then someone recently, it's called Basic Fit, which is basically like a European equivalent of Planet Fitness. Let's just call it that. Planet Fitness, of course, has gone up like 10x. So hey, why can't Basic Fit? It's much more complicated than that. But the idea is like this is a real story with like a real owner operator where this thing could probably compound for 10 plus years, and you think, am I going to make 40% on this in a year? Okay, maybe if the valuation gets pulled forward, but you could probably compound at it 10+%, maybe more, maybe 15, who knows? And after tax, it's probably going to be better than all of this like gunslinging that I won't say we all try to do, but I am definitely guilty of. So I've been looking in the mirror a lot and thinking about whether I really have any more shootouts in me, or if I should be looking for real companies to invest in.
Anyway. Say, give me chased, but not yet.
There's some. I don't think you have to be at that. I mean, I think there are some 10 to 15% returners around in the US at least.
Yeah.
We don't have to do anything too heroic to get there. You know, to be fair though, like
what's your exit multiple on that?
Well, I assume no change in the multiple these days. I've learned my lesson. I do all my calculations based on yield and reinvestment, and just hope that I don't get dinged on the multiple on the other side. So I'm like trying to buy a multiple. It's like sub-market multiple, with the hope that it remains. You know, even if it doesn't move.
Sub-market.
But I try to buy companies that are better than the average for, you know, at a discount to the average. Hopefully that works out.
I mean, I've been meeting with a lot of managers recently just to try to like think about allocating and whatnot. And there's some incredibly talented people. And I don't know that the talent separates some of these people. I think sometimes it's just age and experience. And other times I see it and I'm like, hey, this strategy is probably good for you, but as an LP, I'm not sure it's so great. Like you're really like turning the book a bunch and just certain things that they're doing. You think this is not optimal, you know? So we were, every time
in
we
what sense, too much risk
topics,
for the return? Too much risk for the return? Or too much trading for the return?
All of the above. No. Yeah, it depends. Sometimes it's more institutional oriented. So I'll see the strategy and I'm like, yeah, you're really sharp. I'm sure you're going to make a solid 10, but this is a ton of work and a ton of just like complexity. You know, like I see a lot of complexity to make returns that I think you could make this in a lot more simple fashion. But they're optimizing for themselves. They're optimizing for their GP and they're optimizing to try to get institutional capital, things like that. So every time we have the discussion, I always think like in any discussion around these, it's like, you know, what are you trying to optimize for? I don't know. I feel like that can really lead you to different strategies. I find a lot of complexity for very little upside, you know, and sort of for me, whenever I see complexity, I'm like, that's okay. I just have to be compensated for that complexity. And when there's a bunch of complexity and yet I'm not being compensated, in fact, I'm probably going the other way. I'm just like, why?
Yeah, I'm with you 100%, dude. I just try to pick complexity out all the time these days out of everything. Get rid of the complexity, get rid of the risk. Just lower both relentlessly. And then whatever return you get out of that.
But you have to be compensated, wildly compensated.
Yeah. The more moving parts you have, the more compensation you need. You need the payoff to be big. You need the convexity to be bigger for the complexity.
Right.
There's my t-shirt slogan.
Put that on a t-shirt.
Like there we go.
Will that fit on a t-shirt? You like call the printer. They're like, that's an extra $20 a shirt. I'm sorry, it's too many words.
I only worded in one color.
Like, all right. I was working on it. Today I was working on like a litigation finance sort of deal we're working on. And this sort of issue came up, which is, it's actually quite complex. And the issue is it's so complex. There's so many moving parts that you have to make it as simple as possible. And you have to do your best to make sure you're just getting compensated for the risk because there's no way to beat around the bush. It's risky. But there's enough sort of facts and tea leaves to point that this would probably be a very good risk reward if you're compensated for it. And I don't know. Again, that's been going through my head, which is some of the stuff even I do in my own portfolio. I'm just like, what am I doing? Like, is this for entertainment? Like, why am I taking on so much heartburn?
Those uncorrelated returns though might feel pretty good potentially.
I mean, nothing's
that's kind of what that's one
uncorrelated.
of the, well, I mean, isn't that sort of one of the selling points about what you do though, is that tends to be hopefully somewhat uncorrelated from market returns?
Some of the stuff we do, yeah, for sure. And I think that there's a great, I've went over this. I think Toby, I think we spoke about it like eons ago. When you had me on the pod, which thank you for having me on that time. And thanks for having me on today. But I think I was saying there's what's his name? Andrew Ratliff. I think I'm saying it's either Redleaf or Ratliff, the guy from Whitebox, the founder of Whitebox. He has two great investment sayings, which I just love. One of them is in investing, everybody thinks you get compensated for taking risk. And I have the opposite theory, which is I think you get compensated for eliminating risk. And the theory he gives is twofold. One, he says a tightrope walker. It's a tongue twister. And he says, everyone thinks, oh, he gets paid a lot of money because he walks on a tightrope, and boy, isn't that dangerous. And you think, okay, he's taking all this risk. Actually, it's the opposite. He's the reason, if he dies the first time he walks on a tightrope, that's not a great compensation at all. And so really he's getting compensated because as a kid or as a young person, he probably really practiced a ton, him or her practiced a ton to the point where they almost eliminated the risk. And that's why they make a lot of money, because they don't die the first time they get out there. In fact, they can walk it a gazillion times because they practice so much. So they sort of, the fact that they've eliminated the risk means they make money. And then another example he gives is like an insurance company. Everyone thinks, oh my God, an insurance company takes so much risk. But actually the insurance company is compensated by eliminating the risk through the law of large numbers. And so it's actually the opposite of what everyone thinks. And I think similar to what we do is we underwrite a portfolio of things to where we're hopefully not, I don't want to say we're eliminating risk, but we're really sort of catching like an extra amount of return by
per unit of
somewhat,
risk.
Yeah, per unit of risk across the board. Like we write a bunch of good policies, and then across these policies we make money. And I think that's just any business. I don't know that that's like, an investment strategy. So.
Yeah, I couldn't agree more.
And there's another one too. I forgot what the other one was.
Well, you have to have you on so you can get the second one, Tom.
Sorry, I'm a talker.
Do you have the second one?
Sorry,
can you look it up?
Oh, you want to hear it? Okay, the second one, that was a great one. This is going to be a letdown because the other one's so great. He says, what does he say? It has to do with, it's going to come to me. Oh, most guys think they're producing alpha when they're managers. They're not producing alpha at all. Most guys he refers to them as beta scalpers, meaning you have a very specific skill set and you overlay that on some pool that you're playing in. I don't know, like TNT companies, or if you're doing bankruptcy trade claims like us or something. And, that's the return for that market. And if you're skilled, you can access that return. And so it's not really alpha. It's really just like beta, but you have a particular skill that allows you to he calls it beta scalping. We can post the paper in the show notes. He wrote an article about this. But I love the idea because it makes you get out of this mindset of like, I'm supposed to be out there like outsmarting everybody.
Good stuff.
He's retired.
That's time, folks. Same bet channel. Same bet time next week.
Well, next week.
Too fast.
Is it not?
Extravaganza next week.
Oh, it's 100. It's 100th next week.
Whoa.
Yeah, we're doing something.
We have something in the
special.
works. Maybe. We'll see.
Cranberries?
Yeah.
Cranberry and turkey?
Well, we can't afford
Can we
that
afford turkey?
because of inflation.
We dropped the first one on Thanksgiving in 2019. So this will be 100th on Thanksgiving 2021. Wow.
I love that kind of symmetry, don't you?
Isn't that amazing?
All planned.
This is fun. Thanks, everybody.
Thanks, Thomas.
Thanks, Tom.
Thanks, guys.
See you next week.